Hi there, and welcome to Foster Group's Financial Perspectives, our regular conversations about things we believe will help investors better understand and navigate the world we're living in. From time to time, we get a chance to interview people that we think have unique insights and that just about anybody could benefit hearing from. And today's very special guest is Marlena Lee from Dimensional Fund Advisors in Austin, Texas. I've had the good fortune to know and to learn from Marlena for a number of years. She's a highly qualified and experienced investment professional and academic as well. But thankfully, she's also very quick-witted. She's patient when it comes to answering questions, especially mine. And I think she's remarkably easy to understand, which makes her a perfect guest for Financial Perspectives. Let me just give you a brief formal introduction of Marlena so you know the quality of person we're talking about here. Marlena Lee is Dimensional's Global Head of Investment Solutions. She leads a team dedicated to providing clients with thought leadership, analysis, and education, and a wide range of investment-related topics. In addition, she's a member of Dimensional's Investment Research Committee. Marlena previously served as the co-head of research, helping shape the firm's global research agenda. And prior to joining Dimensional, Marlena worked as a teaching assistant for Nobel laureate Eugene Fama, professor at the University of Chicago Booth School of Business. Marlena earned her PhD in finance and an MBA both from that school, and she also has various economics degrees from the University of California, Davis. So Marlena, welcome to Foster Group's Financial Perspectives, and thanks for taking time to answer a few questions today. I've really been looking forward to this conversation.
It's so good to be here, Kent.
So let's start out this way. For all the years that I've known you, I've often asked you what would represent the best way to invest, how to allocate the portfolio. You seem to consistently respond that the answer, or maybe the certainty that I and many investors wish for, doesn't really exist, at least as a sure thing. Now, Foster Group has worked with Dimensional Fund Advisors since the mid-90s. David Booth and a few others founded DFA 40 years ago now to give investors better access to certain premiums found in the academic research. For example, higher expected returns in small company stocks, as well as low-priced or value stocks. So to start out, if you would just give us a quick overview of how you would define a premium and if they're different than factors, which seems to be a popular word in investing today.
Oh, absolutely. So premiums versus factors. While we at Dimensional do distinguish the two, I think that they're often used as pretty much synonyms out there in the industry. So they're just things that tell you here are different stocks or securities that have higher expected returns than others. So the difference that we would identify as a premium is just what is the size of that difference. So is the premium 2%, 3%? And then for a factor, it does have a specific meaning in the academic community, which is it's a portfolio that helps explain returns broadly. But setting those things aside, basically there are things where the academic research has identified differences in expected returns. And hopefully those are things that you can use when you build your portfolio to pursue better expected returns or manage risks. So that's the short answer. Of course, we can. there's a lot more if you want to unpack that one.
Yeah, no, I appreciate that. We've read some. I can only go so deep. Even myself, it's like, okay, that's really interesting. But I think the idea behind the premium is, so there's research that would say there's certain kinds of stocks or classes of stocks or groups that tend to have a different expected return than the market as a whole. And if you look at those premiums, some are more or less recurring. There's some time frames involved. Some are bigger or smaller in the research. Two that we spent a lot of time thinking about at Foster Group are kind of the value premium and the premium associated with small company stocks. The thing that we all know is they don't come all the time. Sometimes you have to be patient. So the question is, how confident should investors be in past premiums, things we've seen in the past, recurring in the future, and at what kind of interval? In other words, how confident can we be in the world we live in today? And then how patient do we need to be?
Yeah, that's a question I get a lot. And I think that there is really two important parts to answering that question. And the first part is probably the most important, which is there a good reason to expect that premium to be there? And then, of course, second, you want to look at the data, historical data. But as far as these premiums, so let's just use the equity one, because I think that that's where people have the greatest confidence that there should be a positive equity premium. In other words, stocks should outperform bonds. And why is that? It's because if there weren't a premium, then investors wouldn't invest in stocks. They're so much more risky, volatile. They need to be compensated to hold stocks. So it makes sense that the price of those stocks would come down to the point where investors were willing to buy them. And I point that out because when it comes to the value premium, actually everything is about that price. So why is it that value premium should have higher expected returns than growth stocks? Well, it's because they're lower priced. So their price has been bidded down by investors. And that necessarily means that at least in expectation that they should have higher expected returns holding all else equal. And the second part of that, the data piece of it, it has been borne out by decades of data all around the world. But to your point, it is quite noisy, and you can go through these long periods of time where a premium might not show up, whether it be the equity premium, which also has long periods where it might not be positive, as well as the value premium. So unfortunately, we can't really predict when these premiums are going to show up. The best we can do is kind of be there when they are, so that we can capture them.
Mm-hmm. So unpredictability, that's part of it. How patient, when investors think about their portfolio and pursuing these premiums, how patient are we going to need to be in order to say, well, we know they don't show up all the time, and sometimes they go for a while without showing up. How long do I wait?
Unfortunately, that one doesn't have a super precise answer. I think all of investing takes a bit of patience, at least in terms of what I would expect. Just like I expect stocks to outperform bonds every day, I know that they're not going to, because there's a lot of noise around that. Here's the way I like to think about that is that if you're a casino in Vegas, right, every single bet a player places, you expect to win a little bit, or flipped around, if you're a gambler, you should expect to lose a little bit. But because there's so much noise in there, you can have long streaks where the gambler might win and the house loses. But with every single bet, it's at least expected that the gambler will lose a little bit. It's like that just for investing as well, where you should expect a positive return every single day. But because there's so much noise, you can go through these long streaks where the premium doesn't show up. At least when you look at the historical data, if you're looking at just like this equity premium, so stocks outperforming bonds, typically over a 1-year horizon, it's about 1 in 3 years that you get a positive or a negative premium. So 2 out of the 3, you're expecting a positive premium. So what does that look like as you extend the period? Just like if the gambler's gambling for a longer period of time, you expect him to lose more and more the longer he's there. That's why the casinos like to keep you in there. The longer the period, the more likely you are going to have a positive premium, or the less likely you're going to have a negative premium. So looking at that negative side, how likely is it? It was 1 in 3 over a 1-year period. For over a longer period, 5-year period, it drops to 1 in 5, so roughly about 20%. And then over a decade period, it drops to roughly 1 in 7, so about a 15% chance of having this negative decade. And that's true. It's roughly a similar magnitude if you're talking about the equity premium or the value premium. So when you look across all of these different premiums, they're all quite noisy, but if you can be patient, and luckily, if we can get investors to invest with a longer time horizon, typically investors, especially if they're saving for retirement, do have decades long time horizon. So it is really important to be able to weather this volatility or just the periods of underperformance, because in the long run, the historical data does show that these premiums are more likely to pay off the longer you have.
Okay, that makes a lot of sense. We've seen that throughout history and the data. We've talked about this a number of times before. One of the questions that investors have when they think about these premiums is we've talked about tilting the portfolio. So some investors will say, well, and you've said this oftentimes, the market is a perfectly good portfolio. But if we want to have a higher expected return over some longer period of time in the market, we're going to need to tilt the portfolio, or own more value than growth, or own more small than large in terms of how they exist in the market naturally. In terms of sizing tilts, what's what seems reasonable in terms of looking different than the market? I mean, how different should an investor choose to be in pursuit of these premiums?
Yeah, it's all about trade-offs. And to the extent that you can tolerate these periods of underperformance, then you can probably pursue them a bit more aggressively. But how willing people are to look different from the market and underperform in periods of premium underperformance, that's going to vary depending on person by person. Just like how much you want to invest in stocks versus bonds will vary person by person depending on their tolerance for risk. When it comes to looking a bit different than the market, the risk is a little different. It's not just, how volatile is my portfolio or my account balance. It's really looking at that index performance that they cite on the news like every single day and being able to look different from that. So, and by look different, a term that's often used is tracking error. But really here, I think it's underperformance. So tracking error is one measure to ask how willing am I to look different from the market? And I will point out here that you can even start with a really basic question, which is, what is the market? Because we actually think of the market as that global portfolio of all stocks and bonds. Whereas oftentimes when people talk about the market, particularly if you're a US investor, we're thinking about the Dow or the S&P 500. That's 500 stocks out of 3,000 in the US alone, whereas there might be 10,000 or more when you get outside of the US. So even investing internationally involves some deviation from the S&P 500. And in a period where the S&P 500, US stocks have done really well versus stocks outside of the US in this last decade, even that decision to be globally diversified would have involved some tracking error relative to the S&P 500. But it's really important to be globally diversified. We saw that just in the previous decade where the S&P was actually one of the worst performing markets in the world. So because you never know where returns will come from, what countries, what regions, you do want to hold them all. So global diversification is already one way that you'll look a little different from like the S&P 500. But you're holding the global market. And then there's an additional consideration, which is how much do you want to push into these segments of the market with higher expected returns? So small companies, value companies, and those will also cause you to look a little bit different from the S&P 500. But those stocks will also give you the chance for higher expected returns. So it's this trade-off of how much can we underperform the S&P 500 and really understanding why you're invested in some of these stocks, I think also enables investors to be able to take on more difference relative to the market in order to pursue higher expected returns, right? If you know you're doing it to mitigate single country risk by global diversification or to pursue higher expected returns by investing in small cap or value companies, then those are all good reasons to look different than the market. But again, everyone's tolerance to how much really underperformance they can tolerate will differ. And that's going to inform how much of a tilt they should have in their portfolios.
Yeah, I think that's a great example. We've been talking amongst our firm and with clients about an idea, we're calling it relative risk. And the idea is not so much how far can the portfolio go down, which we think it was absolute risk, big, loss of actual dollars, but relative risk is, well, how far or how underneath the US market might your portfolio look from time to time? Because if you're concerned about tracking error, although you may not use the technical term tracking error, you're just concerned about why do I look different from this market that I'm reading about or hearing about every day? That's the error or the track or the relative risk that people, if they're not expecting that or prepared for it, they may make some kind of bad decisions. Again, we were talking about how patient do I need to be? Well, we might need to be patient for a few years of underperformance to actually pick up the outperformance or the higher expected return that we hope to get out of those premiums. Even though there's no guarantee that they're going to show up, the idea is the longer that we kind of pursue those things, as long as there's a sensibility to them, we would expect this was a reasonable decision But we also want to know that when we made that decision, we were making it with eyes wide open. There was a chance for some underperformance along the way, probably a fairly high chance that there will be underperforming periods as we pursue those premiums. I know when Dimensional created some wealth models here in the last couple of years, you all made some kind of decisions as to, well, how much tracking error or how much relative risk do we want to put into our allocation models that we think people could maybe choose from? How did you kind of think about, and I know you've said generally, but when you think about those models, what were some of the guardrails around the allocations that Dimensional developed?
Oh, such a great question, Ken. And I love those terms, absolute versus relative risk. I'm going to have to use that. So some of the trade-offs, so all of them, when it comes to the wealth models, and I'll just keep it to the equity portion for now, because there are also a whole variety of them with just different equity allocations versus bonds. But within the equities, to reflect that there really is no one right way to tilt. There are actually two different levels of tilt. One is, I would say, more of a moderate tilt or almost a mild tilt. And then the other one is much more of a, it's a bit spicier. So they all push to the areas in the market with higher expected returns in a very well diversified way. So again, over 40 different countries, over 10,000 different stocks. And that's the same, but how much they would overweight or tilt to small caps or value stocks varies depending on whether you're in the medium or the large tilt model. And some of the trade-offs there really are that question of, well, how much higher expected return do I want? But in order to get that higher expected return, I have to be more willing to be able to tolerate periods of underperformance, because to outperform the market, you have to look different than the market. And sometimes that means underperformance. So it's just that trade-off there between really expected return and relative risk. And it's really important to recognize this relative risk, because honestly, the volatility or the absolute risk actually looks quite similar across different levels of tilted portfolios, as long as you have those caveats of it's very well diversified. As you tilt between, let's just say, that medium to large tilt, the volatility actually looks quite similar. And the meaningful levels of difference are in that relative risk. So how much you can underperform. We were looking at the global untilted market, but it still applies if you're looking at the S&P 500. So there's really no right answer. And us having multiple models kind of shows that. We kind of leave it to the advisors that we work with, folks like you, Kent, who really understand your clients. And some of that understanding, I know, is based on the conversations of, why am I underperforming? And through that, you get a sense for how much of that relative risk they can tolerate. And we just want to provide here the different tools depending on what type of investor and how much of that they can tolerate. There really is no right answer.
Yeah, I always like that. I find it humorous that coming from a PhD in academics, one of the responses is, there really is no right answer. I didn't have any professors like that in college. They were when they tested, they were asking me for a right answer. So it's good to know that there are not necessarily right answers for every question.
And really, most of them.
The hard ones anyway.
The hard ones, their frameworks.
Yeah. So I just appreciate that. And I think this idea of going back to patience for a minute, what you said about global diversification, I think bears a little bit of thought and repeating as well, that there's a decade of period where the U.S. market underperformed outside the U.S. market. And then there's this past decade where we've seen really strong outperformance inside the U.S. It takes a pretty patient investor to look at a 20 or 20 plus year time horizon and say, that's the reason that I want to be globally diversified. So appreciate that idea of patience. Sometimes I think today we shrink our meaning of patience to the 1 year or the 3 year return number. And we forget that we've got a lifetime time horizon here for many people in terms of how that equity performance is going to be realized. And if our portfolio is built correctly, we don't need the whole thing to perform super well every year, as long as we get, over those 10, 15, 20 year time periods, kind of the planned for expected return over those horizons. So super helpful. I know sometimes that's hard for people to hear because we like to be able to measure things on a shorter period. But for people who really want to have a little bit higher expected return, there's a need to be able to look different from the market, and maybe for longer than we're comfortable with at times. So let me ask a transition question here, because we've been talking about some academic constructs here. Tracking errors, one, premiums, how those premiums are discovered. And certainly you've had a lot of academic experience. And again, I alluded to this earlier, Dimensional is formed, at least in part, to try to bring academic findings into real world solutions. So that's been always really interesting to me. I think it is to other people as well. But sometimes things don't translate quite as well from academia to real world. So what kinds of things are lost in translation, if you will, when we try to go one to the other?
Well, I think you hit on it earlier with that. There's oftentimes no right answer. One thing that strikes me whenever I listen to Professor Fama, as you mentioned, I was his teaching assistant, is how many times he will say, "I don't know." And I think that's an important characteristic for translating academic research into portfolios, is being aware of how much we really don't know. Because the thing about financial research, and that makes it different from, say, medical research, is you can't really construct an experiment to test some of these behaviors. You only get one run at the historical return series. And everybody studies that same historical record of returns. And if you are studying the same data by thousands of people over and over and over, one thing that you'll find is lots of patterns that aren't real. So when looking at an academic paper, you kind of have to ask yourself, how much of this do I expect going forward? And the answer should always be I don't know, but let's do some additional work to get some ideas of level of confidence. You can never prove anything with historical data. You can only get inferences. So when it comes to translation, that understanding whether something is data mined is actually really important. You have to be very skeptical of a lot of the things that you see, partially because there's a publication bias of only the good stuff will get published. You don't get to see all of the stuff that they did that didn't work. And so besides data mining, the other thing that's really important is when you're studying returns, they don't move when people start to try and trade on them or act on them. Whereas if I go into a market and I try to trade, then the price will move away from me. And that's something that you're not going to be able to see in the historical return series. So thinking about a dynamic market and one that has a lot of frictions and costs in it is also something that oftentimes might be ignored when looking at a piece of academic research. So costs in this case go far beyond like the ticket charge of trading, a mutual fund on your platform. There are lots of other costs involved, and they all get just kind of embedded into that return. So one is trading costs. If you trade a lot, especially if you trade a lot in certain types of less liquid stocks like small cap stocks, the trading costs could be pretty big and substantial. So you always have to evaluate what are the things that when I try and translate a piece of research into real life. First is, do I need to protect myself against something that was just mined out of the data? And second, when I actually go and implement this in markets where there are costs, how much of that premium did I see will go away once I start trading? So those are two really important considerations that I'd say Dimensional has had a really long history of trying to be first cautious about how we interpret returns, but also really, really good at minimizing those trading costs so that what you see in the data is actually something you can expect in portfolios.
Yeah. I think that data mining one is so interesting. I remember, I think it was Professor Novi Marks. He talked about something called the factor zoo, this idea that there's just been literally thousands of potential factors identified in previous streams of data. But whether or not they have any merit, that's a whole nother question. One of my favorite kind of data mining stories we use often is the Super Bowl factor. The idea of, did the National or American Football Conference win the Super Bowl? And based on kind of looking at the last 50 years of data, you could say, well, if the National League wins, and the stock market would be positive by X. If the American Conference wins, you go, I don't think there really should be a connection, but if I press the data hard enough, I can make a prediction based on, in this case, 50 observations of data or so. So yeah, I love the data mining stories because you can get some pretty clever but unhelpful conclusions from that, it seems like.
Absolutely. Stocks that start with the letter M, I think, also outperform.
I like that. Hey, this has been a super interesting conversation. There's more things that I'd like to ask you about, but I think we'll, if it's okay with you, we'll take a break and package this one up so that people can listen to it again, or maybe not have to stick with us all day the first time. And we'll come back and ask some more questions that maybe have a little more application or more topical. So if you're okay with that, we'll break right here. Thanks for what we've talked about so far. And then we'll stop the recording and make it available for our next conversation in the following couple weeks. So we'll be right back. Stick with us.